Are you looking for an investment that offers regular income? Then dividend stocks might be a great idea. If you invest in dividend-paying stocks, you will be able to share in the profits of some of the world's best companies. You can even reinvest these dividends to buy more shares that will then create a powerful compounding effect. But you can also choose to take them as pure cash. If you ask us, it sounds pretty neat. Hey, welcome to Stock Market Mate. Today, we'll talk about the 6 best dividend stocks to buy in 2022. The companies that we'll include in this video are expected to produce rapid growth for sales and earnings. They also have high dividend yields. Make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Starting with stock number 6, Intel Corporation. Investors generally don't think about technology companies as big dividend payers. However, there are some exceptions, particularly in more mature tech firms. Intel is an industry-leading semiconductor company that continues to create life-changing technologies. In essence, it advances the design and manufacturing of semiconductors to help address its customers' greatest challenges. Furthermore, the company embeds intelligence in the cloud, network, and edge to unleash the potential of data to transform businesses and society for the better. Intel has used its prodigious profits to move into other, more futuristic fields to augment the core business. One of these, its self-driving unit Mobileye, offers a big catalyst for 2022. Intel will be spinning off the firm as a public company, though Intel plans to maintain a majority stake. Analysts believe Mobileye may be worth $50 billion or more as a standalone entity, generating a huge return on Intel's $15.3 billion purchase price 4 years ago. This will also reduce Intel's capital expenditures, freeing up funds to reinvest in the core business or return capital to shareholders. Intel pays a 2.7% yield today. Stock number 5 is AT&T. T-stock has fallen a lot since last year and now trades a very low valuation. It was actually down over 16% in 2021. If you're unfamiliar with it, AT&T is one of the most recognizable wireless phone carriers in the US. The stock maintains a high 9% annualized dividend yield in a relatively low interest rate environment. Additionally, telecom stocks are sometimes viewed as a safe haven when stock markets turn volatile. So here comes the question. Is it still a great stock to buy? Well, it's still of great value. It's trading at 7.5 times free cash flow, which is a 13.5% cash flow yield. AT&T is a cash flow machine and a reliable one at that. Their core business is vital and all subscription revenue. Recently, the financial performance has been great, completely disconnected from the stock price. AT&T disclosed in a press release that the company saw 1.3 million total postpaid net additions in the fourth quarter, including about 880,000 postpaid phone net additions. For the full year, AT&T recorded 3.2 million postpaid phone net additions, which the company said was its highest total in more than 10 years. The company also added roughly 270,000 fiber subscribers in the fourth quarter and ended the period with about 73.8 million total HBO Max and HBO subscribers globally. Overall, we think AT&T stock in Warner Bros. Discovery will perform very well in 2022 and beyond. Stock number 4, Exxon Mobil. Oil and gas are one of the best performing sectors at the moment, and if you're looking to combine capital gains with regular income, Exxon Mobil is one of the best high dividend stocks in the market. As of February, Exxon Mobil offered a running yield of over 4.50%. This was previously above in the 7 to 8% region, but this has since been reduced in response to the stock's rising share price. For instance, over the prior 6 months alone, Exxon Mobil shares have witnessed gains of over 43%. However, Exxon Mobil has paid and increased its dividend for 38 consecutive years, but it almost cut the dividend in recent years. Oil price declines choked off Exxon's free cash flow, shown in the above chart, in 2016 to 2017 and 2020. The company borrowed to pay the dividend while spending heavily on expensive oil projects, shown as rising capital expenditures from 2018 to 2020. The pandemic put financial stress on the business, pushing management to rethink that strategy and cut costs. Now that oil prices have recovered, free cash flow is improving, which has the company back on solid financial ground. Its debt-to-capital ratio, which measures how leveraged a company is by comparing total liabilities to total capital, is 26%. This is a healthy figure. You know what they say about it. Lower is better. In other words, its balance sheet is strong, and cash flow is healthy once again. Stock number 3, Visa. Payment networks are the glue that holds the economy together. It connects our banks to the stores and shops where we swipe our cards to pay for things. Visa is the most extensive network, providing the backbone for roughly half of the worldwide credit cards issued. This business works as a toll booth. It collects a small percentage of each transaction that passes through its network. Visa's payment network is already established and no longer requires a ton of investment. The company becomes increasingly profitable because revenue grows faster than Visa's costs. About 0.60% dollars of free cash flow is created for each revenue dollar now, making Visa an excellent dividend stock. The company's annual dividend of $1.50 per share has been raised in each of the past 13 years, and the dividend yield is currently 0.7%. The low yield is partly a reflection of the strong stock price growth Visa has generated in the past few years. The dividend payout ratio is about 26.6%, leaving plenty of room for future dividend growth. Stock number 2, Starbucks. Dominant consumer brands can be powerful businesses, and coffee chain Starbucks is one of the most recognizable brands out there. Not long ago, Starbucks was commonly labeled a growth stock that was disrupting the global retail coffee industry, namely in the US and China. Yet calling Starbucks a growth stock today is a bit of an exaggeration. Granted, Starbucks did report record-high revenue of $29.1 billion for its fiscal year 2021, but that's only 30% higher than what it earned 5 years ago. The Starbucks of today is a mature, stable company that is known for its strong brand, international exposure, and consistency. It's also highly profitable and generates a lot of FCF that is used to back its growing dividend. Starbucks sells its beverage products across the world in its 17,000 stores. Starbucks has steadily grown by adding new stores and incrementally increasing its prices to its loyal customer base. Meanwhile, coffee is a high-margin product, enabling the company to generate $0.15 in free cash flow from every sales dollar. The company's annual dividend of $1.06 a share yields 2% at current prices, and the company has raised its dividend annually for 12 years in a row. The dividend payout ratio is about 55.2%, which is quite sustainable. Stock number 1, Johnson & Johnson. If you're looking to focus on conventional equities, then Johnson & Johnson is arguably the very best dividend stock for 2022. Put simply, this strong and stable blue-chip company has been paying dividends to its shareholders for 6 consecutive decades. Moreover, each consecutive year has resulted in the size of the dividend payment increasing. If you live under a rock, let's have a quick discussion on what this company does. Johnson & Johnson, or J&J for short, is a legacy healthcare company that develops medical devices, pharmaceuticals, and consumer packaged goods. It has been around for more than a century and is one of the largest and most broadly based health companies in the world, with a track record of 60 consecutive years of annual payout hikes. Johnson & Johnson has earned a place on the short list of dividend kings. And with a solid business, the drug maker looks set to continue rewarding shareholders with more dividend increases for many years to come. Earlier this year, it was reported that the healthcare giant is in talks with 2 Chinese biotech companies. Evidently, J&J is looking to tap into the biotech industry boom in China, driven by private investment and government support. The 2 companies, which J&J declined to name, come after the company's successful collaboration with Legend Biotech. The 2 worked together on a breakthrough cell-based cancer therapy that was approved by US regulators last week. Given the potential of additional partnerships, would you pass on buying J&J stocks? If you ask us, Johnson & Johnson looks like an excellent dividend stock to buy and hold through thick and thin. Well, that's about everything. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!